So my name's Pettifor. It's my married name. I was Anne Potgieter. My father was Theodorus Daniel Potgieter, and my mother was is Olive Grace Smart. I am the product of both Dutch and British colonialism in Africa, in South Africa. I grew up in a small town called Oudendaalsrus in the Oranje Vrystaat, in the Orange Free State in South Africa, in the shadow of gold mines, and in a flat, bare, desolate landscape, which was punctuated only by great big gold mining dumps, where the dump of rock was placed after the gold was mined. And when I was growing up in that landscape and in that economy, I noticed that the price of gold was $35 an ounce, and that it had been fixed at that rate in 1944. And throughout my childhood, it stayed at that rate when other prices changed. And I remember having big discussions with my dad as he drove his Volkswagen around the veld. And I leaned over and talked to him, and I said, well, why has that happened? And my dad, who wasn't an educated man, tried to explain to me about the Bretton Woods system, the international financial architecture. And I'm not sure that either of us really got it, but it explains my fascination with the international financial system. And then from there on, I went, when I was a grown-up, to lead a campaign called Jubilee 2000, which resulted in the cancellation of the sovereign debts of 35 countries. We had written off something like, in nominal terms, $100 billion of debt for those countries. And in that process, in that campaign, I learned a great deal about the international financial system, about credit and debt, and I learned from the most powerful of them all, the Paris Club of Creditors, the World Bank, and the IMF. And that intensified my interest in credit and in finance. But what I learned really encouraged me. It taught me that we can afford what we can do, that we have the money to do what we can do. And that's the big idea that I want to share with you today. Now, the United Nations Environment Programme says, in a recent report, that we'll need about $2.3 trillion per annum every year until 2050 to decarbonize the economy and to end our addiction to fossil fuels. And I want to argue today that that is immensely, eminently affordable, if only we knew how. But in order to understand that, we have first of all to understand the nature of money and the nature of credit in particular. And I believe that many of us are really truly confused about credit, and I don't think it's entirely an accident. I think society has been screened from a proper understanding of the theories of credit because of their power. Now, the thing about credit is that it is a wonderful, a marvelous thing. It is something which can be created effectively out of thin air. Let me take you back to the year in which the gold price did start to move, 1971. When unilaterally the United States, under President Nixon, without consulting their partners, dismantled the Bretton Woods system, the framework for constraining the mobility of global capital and for constraining the movement of trade. And unilaterally, Americans abandoned that and broke it down and started opening up and liberalizing the price of gold, but also the movement of money. And simultaneously, in my country, in Britain, our Chancellor, Anthony Barber, introduced a revolutionary legal framework. It was called Competition and Credit Control. And to all economists, it's known as all competition and no control. And effectively, what we did in Britain in 1971, which is gradually copied by everybody else, was to deregulate the creation of credit, and furthermore, the fixing of the price of credit, the rate of interest. What we did was we gave that role to something we called the market, the private financial sector. And at first, they played around with this new power rather carefully, but eventually they began to mess around with it. So why does the deregulation of credit matter? It's because of this. We suffer from the illusion that in order to invest in wind turbines, in decarbonizing the economy, we first have to accumulate savings in order to have the money to invest. Prior to investment, we believe we need savings. We also believe that banks function as intermediaries between those who've got savings and those who need credit, those who need loans. And that is a deeply flawed and wrong notion of how the banking system works. And that is largely thanks to Dutch bankers, actually, because they were the ones that developed a sophisticated and enormously revolutionary and important banking system. And it's been wrong in Britain since 1694 when we set up the Bank of England. But because we still have that notion because of what happened in the past. In the past, if you wanted a loan, if your name was James Watt and you wanted to invent a steam engine, you would have to go to some baron, probably, some money lender, some big bad guy in town that had accumulated a surplus of financial assets and hoarded them in the vaults of his castle. And you'd have to go to him and say, look, I've got this big idea for a steam engine. It's going to cost a lot of money, and I don't know if they're going to build railway lines for it, but honestly, it's a big idea. Would you give me the money? And he would very meanly think about whether or not he'd give you a bit of his surplus. And if he did, he would charge you, James Watt, 10% on the loan. Now, James Watt would not know whether or not his steam engine was going to generate that kind of income to repay the loan. And he'd be a bit nervous about taking all that money at that risk, and he probably wouldn't. And then came the Dutch and the banking system. And they developed a banking system which meant that you could create credit in excess of savings. You did not need savings to create credit. Now, this was a wonderful, wonderful and epochal invention. It democratized the allocation of credit. It meant I didn't have to go to the local baron and ask him for his surplus. I could go to the bank where a fairly rational, objective decision would be made as to whether or not I could repay that, and whether or not my steam engine was a viable thing. Furthermore, by the creation of credit in excess of savings, you increased the supply of credit, and by that means lowered its price, the rate of interest. So the wonderful thing about the role that the Florentine bankers and the Dutch bankers played was that they defeated the role of the usurer in society, the man who made money out of money. Because what happened when you increased the supply of credit was the price of it, the rate of interest, fell dramatically. And that enabled James Watt to take on the money to drive his steam engine. And that was a great thing. That was a really important thing to have done. So what we learned from that was that banks do not have to have savings. They do not even have to have deposits in the bank in order to be able to create credit. One of the things that I want to impress on you is this thing, that the money for a bank loan does not exist until you, the borrower, go into the bank and apply for credit. Before that, there ain't no money for your £300,000 loan for your property. Please believe me that that is true. What you do need to do is sign a contract to say that you're going to repay the loan, and you've got to offer some collateral. In other words, you'll hand over your property to the bank if you don't repay. That's all. But there is not £300,000 in the bank when you want to borrow. And if you don't believe me, let me refer you to Mr. Ben Bernanke. He is the governor of the most powerful bank in the world, the Federal Reserve. In March 2009, he gave the first ever interview to a TV station that a governor of a federal bank had given. And the day before, he'd given AIG, which is not even a bank, it's an insurance company, $160 billion. And the journalist says to him, now, Mr. Bernanke, where did you get that money from? Did you raise it from taxation? And he said, no, he said, it's not tax money. The banks have accounts with the Fed, much the same way that you have an account in a commercial bank. So to lend to a bank, we simply use the computer to mark up the size of the account that they have with the Fed. $160 billion. Just put, a couple of keystrokes. No, more than a few keystrokes. And in that year, the central banks of the world generated $14 trillion to bail out the banking system. Now, I want to argue that is a wonderful thing. I mean, I'm not in favor of the way in which AIG was bailed out. They were crooks, those guys. They had messed around majorly. They should have been punished. Instead, they were helped out of their trouble. But if they had not done that, our economic system would have imploded. We would have been starving. There would have been real problems in the world as a result. So it is a great thing that they were able to do it. And what we learn from that, you know, is that credit is not tied to a commodity. It's not a commodity. It's not gold, it's not silver, it's not like oil, and it's not even like Dutch tulips. You know, it is not subject to the laws of supply and demand. There is no constraint, theoretically, on the creation of credit. But what I want to show you is that there can be some constraints. First of all, I just want to show you that if you don't believe me, just 2 weeks ago, Governor Shirakawa of the Bank of Japan generated 2.6 trillion euros to pump into the economy of Japan to aid in the reconstruction of Japan. And that was a very good thing, is what I want to argue here today. However, there are constraints on the creation of this credit, and I want to just run you through them quickly. The first one is inflation. If you create more credit in your system than the economy is capable of generating, then there is potential economic activity, you create inflation. And we've had inflation since 1971 when credit was deregulated. We've had a lot of inflation. You create a sort of debt inflation. If you create too little credit, this is the second constraint, you create deflation. That's what we're experiencing in the Anglo-American economies at the moment, where the banks are not creating credit for the real economy and economic activity is contracting. Businesses can't get a loan to pay off salaries, to finance their overdraft, to buy new kit. So they're contracting their activity, laying off staff, going bust. So if you don't create enough credit, you get deflation. Another big constraint is that if you create credit at a rate of interest is not repayable, you bankrupt your economy and the bank itself, ultimately. So what happened in the run-up to the crisis was that the banks made loans to subprime borrowers, we call them. Hairdressers on $7 an hour in Michigan who took out loans for $300,000 at 17%. And of course they couldn't repay. It was so obvious. But they were desperate for the dollars and the home. Then there's the labor. You know, Mr. Shirakawa can pump money into the Japanese economy, but if there are not enough people, Japanese workers, skilled and unskilled, to do the reconstruction, again, that money will go nowhere, or it'll be inflated and it'll have no value. And finally, there's the ecosystem. We can only create as much credit as the ecosystem is capable of returning to us. So if we lend too much money to Brazil, for example, what they'll do is make their people work 12 hours a day, 7 days a week to make the export widgets needed to repay that debt, and then they'll start stripping their rainforests to earn the money, the hard currency, to repay their debts. So we need to understand that there's an ecological cost to too much credit as well. So while I think that credit is a wonderful, marvelous and important invention which we should take and harness for our benefit, it is also hugely dangerous. Hugely dangerous. I always like to compare it to the story of the sorcerer and his apprentice, Goethe's famous story, made more famous by Walt Disney in Fantasia. When the sorcerer leaves his studio to the apprentice, and the apprentice, who's too lazy to wash the floors with a bucket and broom, decides to conjure up a bit of magic to get the brooms and the buckets to wash the floors themselves. And they do, but they start replicating themselves, and they start gushing out water. And the next thing, as you can see from that image, the studio is flooded and smashed. Well, that's pretty much what we did in 1971, when our central bank governors, the sorcerers, if you like, of our banking system, fell asleep at the wheel and allowed the deregulation of credit. And this was the chaos that resulted. And there is another impact of that, which is really important for us. And I want to show you this. It's quite hard to get data back to 1945. But if you look here, you'll see the creation of credit pre-1971. And then after 1971, it takes off. The red line is the United Kingdom, where, of course, competition and credit control meant that, woof, it went off, and the yellow line is the United States. The Anglo-American economies led in this credit creation. I have to say the European economies were more cautious. And so with that, you get a rise in consumption. It is absolutely dramatic. Again, I couldn't get consumption figures back to 45. The period 45 to 71 is a period of restraint and constraint. But here is 1970, and after that it goes boom. Of course it does, because everybody got credit cards and everybody went shopping. And dead easy it was too. And the consequence of that, of course, is a rise in fossil fuel emissions. Now, my emissions chart is probably not quite as obvious as that, but you will understand, as I do, that there is a consequence if you create too much credit. So for me, the mission is to explain to people concerned about the environment and the ecosystem the links between credit, consumption, and emissions. And unless we make those links, we will not be able to deal with the crises in both of those sectors. If we compartmentalize our thinking into thinking about the environment or thinking about the financial system without thinking about the things between them, we won't be able to address the problem of emissions. So there is a direct line. Now, UNEP says we need to raise $2.3 trillion. I believe that we can, because the economic possibilities of nations does not depend on our financial resources. It depends on our ecological resources, on our human resources, on our organizational resources and powers, not on our financial resources. But if we want to rely on those resources, we have to turn the banking system from its role of master of the economy to servant of the economy. And then we'll be able to afford what we can do. And that's the big idea I wanted to share with you today. Thank you very much.